We are here tonight to break down some of the key points from the One Big Beautiful Bill, or OB3 for short. You'll probably hear us call it tonight, which was signed into law on July 4th. A quick intention for our time together tonight is not about politics or to debate the construction of this bill. One of our most important jobs as advisors is to truly be objective and to focus on what we can control. So our main job tonight is to cut through the complexity and really show you what all this information means for your individual financial plans. Before we jump into the details, I'd love to introduce the team. With me tonight is my co-founder of Vantage Financial, Nick Reiland. Smart, proactive tax planning has always been a centerpiece of our clients' financial plans, which is why legislation like this is so important to deconstruct. And also, I'm so excited to introduce John Beck, the managing partner of Vantage Tax. He has a ton of different experience across different financial, tax, and accounting disciplines, and he's truly one of the sharpest tax experts we know. We're absolutely honored to have John as our partner and a fixture in so many of our clients' lives. And I am Tim Kuntz, co-founder of Vantage Financial. Between the three of us, we have spent decades guiding families through all kinds of changing tax laws, different environments, and especially retirement transitions. While we've seen laws come and go and markets rise and fall, there's one thing that really remains the same, and what matters most is how you plan through it. So we're really excited to connect the dots for you tonight, and let's look at how we're going to structure our time. So here's our roadmap for the night. We're going to go through an overview of the bill, some key individual changes, considerations for families, retirement, some important points for businesses and small businesses, and we'll wrap with some takeaways, Q&A, and some closing remarks. So throughout the time tonight, if I could get you all for just 1 second to make sure that you can find the Q&A. It might be in a different place for each of you, but there should be a button maybe on the lower part of your screen, or if you're on a mobile device or tablet, you might have to scroll over. But if you could just find the Q&A, make sure you see it. This is your place to throw questions out to us tonight. So feel free to drop questions in here as we're going through the material. We're talking about the key concepts. If it makes sense for us to answer some of them while we're presenting, we'll certainly do so. But as I just mentioned, there will be a dedicated time for some Q&A a little bit towards the end of our presentation tonight. So again, hopefully all of you have found that. I see that someone even went so far as to raise their hand. Hopefully that means that you found it. Thank you. And again, please feel free to drop questions in there as we go through the presentation tonight. All right, why don't we start with just a high-level overview here of the One Big Beautiful Bill, or again, OB3 for short. This was signed into law on July 4th, 2025. It is an absolutely massive bill. There is a ton of different legislation in there, and I'll tell you that tonight, we're literally only going to scratch the surface. I do want to point out one thing. The title, One Big Beautiful Bill, is actually literally the title of it that was passed through Congress. That's not just something that we're calling it tonight. We like calling it OB3. It rolls off the tongue. So if you hear us mention that tonight, that's what we're referring to. And again, One Big Beautiful Bill is the actual name of the bill. So there are a ton of considerations in here, and there is no way we could get through all of them in just an hour of time. But this bill brings in some provisions that are pretty favorable, and some considerations that might change the way you look at some elements of your financial future, just depending on how your plan is structured. But the big takeaway is that your plan really needs to be flexible to adapt no matter how Washington changes the rules. So let's drill into some of the provisions that impact you guys directly.
Yeah, I find it interesting that it was passed saying it was a goal of the bill was simplification. All of you know the tax code is very complex. When you look at all the private letter rulings, all the changes in the tax code over the years, I think it's well over 70,000 pages long. So I wouldn't put the word simplification along the IRS ever, but that's neither here nor there. They just keep stacking on top of each other. But one of the best provisions of this bill was that it made the tax brackets permanent So back in 2017, there was the Tax Cut and Jobs Act that was passed, and that lowered a lot of income tax brackets across the board. And if they hadn't gotten something in place this year, those brackets were set to expire and revert back to the pre-2017 levels, which would have been on average for most middle and upper class families. In our country, it would have been about a 20 to 25% increase in their taxes. Just as an example, the 12% bracket was moving to 15%. The 22 was moving back to 25%. Well, on the surface, 12 to 15 doesn't seem like a lot, but that is in fact a 25% increase. So that was good news. We've got the seven bracket system, as they call it, starts at 10%, goes up to 37%. So that all stayed the same. And it will continue to be inflation adjusted. So if we go back to 2017, actually the first year under that act was 2018, but we go back to 2018, the amounts in each of these brackets, both married filing jointly and single, were smaller amounts. It's been widened for or because of inflation. So that's been a real positive. So even just taking a few, glances here, you can have for a single person almost $200,000 of income at the 24% bracket and almost 400,000 for married filing jointly. It's a substantial amount of income at a very reasonable bracket. Those of you that have attended our taxes and retirement class over the years, we've compared our current tax system with 1980 when there was a lot of inflation and a much more unfavorable tax code where a middle class family was in the 43% tax bracket. The beauty of this current plan is that we don't even have a 43% tax bracket, and even the wealthiest Americans are only at 37%. So very favorable, very predictable with your income. One other note, they made these permanent, and I wouldn't say that anything is ever permanent in Washington. So while they're permanent, there isn't an expiration date like the previous plan. These can absolutely be changed, modified. You could get a new administration in a few years that could come in and completely overhaul the complete tax code. So we're operating, under the assumption that these will be good for the next 4 or 5 years, hopefully longer because they are historically very favorable. But just keep that in mind. It doesn't mean this is going to be your the tax brackets for your entire retirement or over the next, 20, 30 years.
Yeah, permanent in our government just means until the next act of Congress on that legislation. So, good point.
Yep. So one of the major advantages was this new senior deduction. So probably many of you heard they were talking, before this bill was passed, of not taxing Social Security at all, like making it a completely tax-free income source. And we felt like that was a pretty big hurdle to climb because there's quite a bit of tax revenue that comes in from Social Security. So that didn't pass. Social Security is still taxable. Now, the Social Security Administration sent out a letter to, I don't know if it was every person receiving Social Security, it was quite a few Americans saying that it was no longer going to be taxed. And that was an error. I'm not sure what happened there, but what they did pass was this new senior deduction, which is not tied to Social Security, but often gets confused as though it is tied to Social Security. So it's a $6,000 deduction per person age 65 or older. You get to tack that on top of your standard deduction. And there are some phase outs. So based on your income, you start to get phased out. So for single, once your income is above 150,000, the amount above that, this deduction gets subtracted by 6%. So let me give you an example. Let's say you have $20,000 over the 150, and you're single. Take your 20,000 times 6%, and that's $1,200. So take $1,200 off of the $6,000 deduction. So you'll still get a $4,800 deduction. So it gets completely phased out 100,000 above that limit. So at 250,000, you will not get this additional deduction. Married filing jointly, it starts at 250,000. Same thing. If we're 20,000 over that limit, so let's say your total taxable income is 270,000, it'll be a $1,200 reduction to your deduction. So each spouse will get $1,200 less. So really a $2,400 cut to that 12,000 total deduction. And again, that gets phased out 100,000 above that limit. So at 350,000 gets phased out. So if you look over here on the right side of the slide, we show before and after. So before OB3 of single standard deduction, 15,700. Married filing jointly, 31,400. We tack on this additional senior deduction, and it's a big jump. 21,700 for single, $43,400 for married filing jointly, essentially standard deductions. So if you're married, your first $43,400 is completely tax-free. Now, this does have an expiration date. This is only good through 2028. Or is it 29? Do you guys remember, John or Tim?
I believe it's 28.
28.
Ends in 28, correct.
Yep. So through tax season 2028 or tax year 2028. So it's a short time frame. And again, this is not tied to Social Security. Doesn't matter if you take Social Security or not. You just have to be over 65 and fall in these income limits.
Very good. I've been really waiting for my chance to talk here because Tim said some really, really nice things about me to start. I guess you guys might want to give me a call another time and see what Tim says about me behind closed doors. But no,
Don't
I'm
fail
really
me, John.
oh geez, well I'm outing you. But no, I wanted get back into the details, but express to everyone here, as some of you I've spoken with, some of you I haven't. But I'm really excited to be formally involved. Tim and Nick and I have worked together for years now, and this is a lot of work having gone into this, and I'm really happy to be here. So I encourage any of you, if you don't know how to reach me, please do. I look forward to meeting as many of you as possible. But with that, we'll keep moving and be cognizant of your time. Moving
Hey,
on,
John,
Marty.
hey, John, just 1 second. Yeah. Okay. You're going to answer Marty's question.
Marty, yeah, exactly. This is a quick one, so I appreciate the question, Marty. Marty asks if only one spouse is over 65. Married filing jointly for people, this is not an all or nothing thing like some married filing jointly situations are. If one spouse is over 65, that spouse is potentially eligible for the $6,000 deduction, depending on the combined income of both. And hopefully that makes sense. If you guys want more clarification on that, please let me know. But again, each spouse is kind of eligible individually and then combined to the top, combined with your income. So moving on there. Another thing people have heard quite a lot about is no tax on tip. I'll make a quick note on no tax on overtime, because it's very similar. So again, what you kind of read as how the bill was initially pitched versus what actually passed when the number crunchers got involved. Tips are still technically taxable as well, right? So this is pretty similar to some other things you're going to hear about here, but you're going to get a deduction for tip income up to $25,000. So, just imagine you're a server at a restaurant or a bartender, someone who is, and right, a big chunk of their income is in tips. Actually, on the W-2 already, there is a part for indicate tip income, and the first 25,000 of that tip income is going to be excluded from your income altogether, up until an individual earns 150,000 or a married couple earns 300,000. So this is one of those cases where the reporting on W-2s, et cetera, is going to be updated and probably short up a little bit in how the IRS asks employers to report these things. But if you have tip income, you're not really going to have to do anything to make this happen, right? It's going to be reported for you. And as far as timing goes of tips or et cetera, right, you're probably going to see some people getting more tips reported than in the past, and I think the government kind of knows that too. So I think everyone wins when you think about it from that perspective. But again, this is pretty straightforward within those income limits. And before we move on, you've heard probably no tax on overtime. same exact scenario, except for the limit on the exclusion of overtime income is 12,500 rather than 25,000. But otherwise, the same provision, if that makes sense. And the auto loan, we've got a lot of questions about this one already. So this is going to be new for anyone who has never owned a business or otherwise deducted business assets. You have not been able to deduct auto loan interest in a very long time, right? So you're not even kind of used to this as being part of your tax matrix, and for now, a lot of people it will be. So as far as the stipulations go, right, we have a similar phase out range, 100,000 or 200,000 married here, but the trick is your car must be, we use the word built. The technical term in the tax code is final assembly in the United States. So this is another instance where your lenders and other people who are reporting things like 1099s to you, this will be a new form that will indicate if you're eligible for, if the car is eligible, right? Final assembly in the US, and how much interest you paid in a given year. And then if your income is within those range, you get a tax deduction that is phased out, evenly over the course of that range. So hopefully pretty straightforward, but something new for you guys to look out come tax time.
Yeah, real quick question, and this is, we had our slide was incorrect on the senior deduction. So Jim, thanks for your
Thanks,
question,
Jim.
clarification. Yeah, that slide should have shown the phase out ranges. So Tim, if you want to go back to the senior deduction slide real quick, that was incorrect. So yeah, the phase out for single starts at 75,000 and ends at 150,000, and married filing jointly starts at 150 and ends at 250. So good catch, Jim. Sorry guys, we had that incorrect.
Thanks, Jim.
So we made note to talk to you guys about how this is all really new, and I will take a quick aside. You guys probably have similar experience. I've had tax numbers seared in my brain for 8 years now, and I got to learn new numbers for this year. And so, that's a good case in point, right? As you hear things and we work it out, all the final regulations haven't been written. The law has, but how we implement it and report it, et cetera. So, thanks for bringing that up, Jim, and we'll keep moving. But the SALT cap increase, I think once people kind of read about this and got the lay of the land for about a month or so after it settled, this is top of mind for a lot of people that I've been talking to. And, if you live in Illinois, for example, right, like a lot of us do here, this is potentially going to be a really nice thing for you, right? However, right, we still have this phase out limit beginning at $500,000. It will phase out, but never reduce below 10,000 for the state and local tax deduction. But for most American taxpayers, $500,000 is a pretty generous number. If you've done really well in your life and have saved quite a lot, or you earn quite a lot from your job, unfortunately, this benefit may not end up being available for you. But for those who are under that limit, they're potentially able to deduct up to another $30,000. Now, a couple things to note on this. This is an itemized deduction, right? So some of the other things we've talked about till now, these other deductions, you don't need to claim itemized deductions to claim them. This one is still. So in that regard, if you are married, we're going to use a round number of $30,000, right? That standard deduction from last year. And your state and local tax is $15,000, you still would not benefit from claiming this, right? You'd still take the standard deduction. So this still takes into account things like mortgage interest, and it takes into account things like charitable giving as well. And so we're going to want to bring that back up later as we talk about some action items and planning items here. But like I said, for most taxpayers in states like Illinois, New Jersey, New York, or California, this is going to be a really nice thing, but there's a lot of complications. So I encourage you to ask questions, and perhaps we can talk later about your own specific scenario, right? Because there's a lot that can be subject to change, right, depending on your own situation. So
I just sent out a couple of answers in the chat, but I'll repeat them for everybody. So someone asked what SALT stands for. It's state and local taxes. They also asked what the SALT deduction was for single filers. It's $10,000 per return, FYI.
And going to 40, as it says here.
Correct.
Yep. Regardless of single or married.
Exactly.
no, thanks for answering that, Tim. I was about to step in. Very good question, guys.
Okay, so let's talk about the child tax credit expansion. This was increased to 2,200. That's coming from a level of 2,000. But there are phase outs here that apply as well. So the phase outs start at 200,000 for single households and 400,000 for married filing joint. The way that the phase out works is for every 1,000 of income over the threshold, the credit is reduced by $50. So should be pretty straightforward. This was something that was actually scheduled to go down. It was going to revert back to 1,000, which would have been the pre-Tax Cuts and Jobs Act level. So kind of nice for families, especially young families. This is a really good credit for them to get back into and potentially continue to increase as well. And I believe this is a credit that might potentially be linked to some inflation on an ongoing basis as well. Next, the estate tax exemption increase. So before talking about the increase, it's worth noting that over history, the estate tax exemption has been somewhat of a volatile number. This is something that with different presidential administrations, they'll raise or lower this number. Prior to OB3, the estate tax exemption was already pretty close to the highest in history, if not the highest in history. And so now it's been made permanent, again, permanent with, air quotes, permanent until another act of Congress. But it is scheduled to rise to 15 million per person in 2026. Good news too is this concept of portability was preserved as well. Just a quick refresher on what portability is. It's basically in the case of a married couple, if I pass away and I only use 5 million of my $15 million exemption, my wife gets to absorb the 10 million that I didn't use and apply it to our remaining estate or her remaining estate. So portability is a great feature within our estate tax exemption. So it's really good that that's sticking around and wasn't impacted. But really good estate planning still matters here, especially when you start looking at things like state taxes, state estate tax exemptions. I know many of you on this call are joining from different states. It's important to understand what those laws are in your area. As an example, in Illinois, per person, we have a $4 million estate tax exemption, and it is not portable. So although this number is really high, it does not negate good actionable estate planning if your situation might be impacted. Okay, so next we are covering the EV credit. So this is actually something that unfortunately was eliminated. There was some confusion too, and as a reminder, I meant to give everybody this word of caution at the beginning. If you're going out on your own and doing like a quick Google search on this bill, understand that there were a lot of iterations of it, and some of the information on the internet, whether from a news source or you name it, is referencing previous iterations of the bill. So the timing of some things changed in the actual final passed legislation, the amounts, the dates, the phase outs, lots of different things changed. So just be careful when you're digesting this information. There's definitely a lot of misinformation being spread. The EV credit, this was a confusing one for some people. Some people thought that even if you bought you bought an electric vehicle in 2025, you'd still get the credit. That's not true. You would have had to purchase the vehicle in 2024 to still get this credit. So for all electric vehicles purchased in 2025, this credit no longer applies. There are some state incentives that are still allowed. This is a state by state discussion, so you really need to review the rules in your state. And the elimination of this EV credit also spanned to some residential clean energy credits as well. So this applies to things like solar panels. If you're making more energy efficient, like the HVAC in your home or more energy efficient windows, there were some credits that you could qualify for, and that is no longer the case. So, if you're not already working with your CPA or tax professional on whether or not your state qualifies you for any of these things, make sure that's a question you ask if this is a project you had planned this year.
Yeah. And on that note, another thing that has had a lot of confusion about it, the Trump accounts. So this has gotten less attention in the media generally than I would have expected when I was first reading about this. Um, and I'll preface the conversation from here, right? If you guys have questions on this one, as Tim did before. Frankly, this is the part of the law that probably is the least well fleshed out from an operational perspective, right? Like, how do you actually do this? So, of course, we're thinking about this, and if you are too, we're happy to think through it with you. Um, but we know how it works, right, as the law is written. So here it is. The Trump account is a qualified account structured similar to an IRA, held at a custodian, right, and sponsored or opened by people like us, right? How we do all that, again, is still being worked out. And this is something you'll probably see more of over time. But you have this interesting choice here this year, and it is a choice. They don't give it to you immediately. You claim on your tax return to claim a Trump contribution for any babies born this year or through 2028. And the government will fund $1,000 to seed that account. From there, you can have $5,000 contributed from any source to this account. And then at age 18, it converts to an IRA, similarly structured to an inherited IRA. And from there could potentially be converted to a Roth IRA or used for whatever purpose the child needs. So a couple points to make about this. The account stays with the child. It's tied to their social security number as it would be to like your IRA, for example, or your retirement account. Even though you're married or the child might grow up and be married, like an IRA, it's tied to him or her. Another thing to keep in mind regarding the contributions to these, similar to 529s, the general understanding right now is that these are considered gifts. And so, the interesting thing is you each have, an individual exclusion gift limit, but the $5,000 limit per child per year is firm, right? So you can't give 5,000 and someone else give 5,000, right? What we're saying is this account can receive 5,000 per year. It grows tax deferred until age 18, at which point the child has a choice of what to do with it, right? So you can see some planning opportunities potentially here. And, we're trying to think about and work out the mechanics of how these are opened and what the best use cases are. But again, there's a lot of vagary here, frankly, in the way the law is meant to be implemented rather than written, if that makes sense. And how to even open them at this point, right, is not entirely clear. So, please be on the lookout for more information from us as we go through your plans over time, and this might be a tool in the toolkit. All right, and lastly, as far as the provisions go, this is a point where I'd really encourage you guys, again, for questions, because this is just like the SALT deduction. Applicability here depends on your kind of individual situation, and this isn't going to even fit for a lot of people. But regarding Taxes on businesses, as the IRS understands it, right? Business income. Um, there is what's known as the QBI deduction, that's qualified business income. That's where anyone who makes business income from an entity or effort that they drive themselves gets to deduct 20% of that business income, within some ranges that are extremely broad, for the most part. That is preserved and also made permanent. Um, as a matter of fact, the current framework has just become a little bit more generous, but if I didn't tell you the numbers, you probably wouldn't even notice the difference. It's just, slightly more open. And so this is a scenario on QBI, consider it mostly unchanged and more so preserved for the future. Bonus depreciation is a very interesting case. And Tim had mentioned these numbers like 2027, you read one place and another. There's different kinds of bonus depreciation, right? So again, as you're thinking about this, it might apply for you in one case or another. Bonus depreciation is if you buy an asset for business that has a useful life of more than a year. By tax law standards, as the book is written, you're supposed to claim a deduction for depreciation of that over, 5, 7, 27 years for real estate, up to 39, depending on what you're buying. Bonus depreciation allows you to deduct the entire expense immediately. It is a election each taxpayer can make on their own tax return to choose bonus depreciation or to elect out of it. But to put it very simply, our government has said, if you want to invest in your business by buying assets, we're going to allow you to depreciate that immediately to make it easier for you, right? That's kind of the goal here. Lastly, on Trump accounts, we were talking about this before, the $2,500 limit that employers can contribute. If you're still working and you're going to be working for a while, I'm sure you're going to hear a little bit more about this over time. You probably haven't heard much about it yet, but going forward, employers can contribute as a deduction to them, non-taxable income to whomever receives it, $2,500 to a child's Trump account. And again, with that $5,000 total limit, that $25,000 is not in addition to the five, right? It's not 7,500 with the employer contribution in your own. That 2,500 comes from the limit of 5,000. So if you ever find a scenario where an employer says, as a benefit, we will contribute to any of your children's Trump accounts, right? That 2,500 is their half, and you could still do 2,500. So just remember on Trump accounts, right? The $5,000 limit is pretty firm. And again, not a lot of information now about how that's actually done, but I'm sure you will hear more over time, especially in an employment benefit scenario.
All right, so different planning opportunities. I mean, by and large, the current tax plan was really extended. We talked about it with the tax brackets remaining the same. There's a few things we just talked about that are new additions to the tax code, but by and large, most things are kind of status quo. But it gave us more clarity because we thought that plan was going to expire at the end of the year. So one big area we help a lot of clients with this would be Roth conversion strategies, where you're taking money out of your pre-tax IRAs, taking some or all of that money and moving it over to a Roth IRA. It's taxable in the year that you do it, but the benefit there is all future growth will be completely tax-free. So if you're like us, we believe taxes are going to go up in the future. We don't know exactly when. Obviously, this current plan extended the current code for quite a while, but who knows? 5 years, 10 years from now, taxes could be considerably higher. And the more money you have in a tax-free account like a Roth IRA, the more beneficial it will be. So this is really critical in doing like incremental Roth conversions, where we spread conversions out over a number of years with a big goal for a lot of clients. We want to limit their future required minimum distributions, which depending on the year you were born, it's either 73 or 75 now. So as much as you can get out of pre-tax IRAs and over to Roth IRAs, the better it's going to help you when you hit that RMD age. Because the thing that we hate seeing is when somebody reaches required minimum distribution age and they're forced to take out a lot more money than they need to live on. So maybe they're living comfortably here, and the IRS says, oh, wait, you got to take out another 20, 30, $80,000 from your IRAs, which we're going to tax you at your marginal tax bracket. Many times you can get kicked into a higher tax bracket. It's money that you don't even need, but yet you have to pay tax on it. So that's one of the biggest goals there. And it also kind of touches on estate gifting strategies. So I'll touch on that one in the bottom right there. A big change back in 2019, it was called Secure Act 1.0. There was a big change to how inherited IRAs are treated. And prior to that act, it started in 2020, anyone that passed on an IRA to a beneficiary, the beneficiary had to take out a minimum distribution every year, but they could extend that account over their entire life. So they could take a little bit out each year and continue that IRA indefinitely. Well, with Secure Act 1.0, they changed that to a 10-year rule. So if you inherit an IRA, you have to deplete that IRA by the end of the 10th year after death. One exception is a spouse. A spouse can take their deceased spouse's IRA and make it their own, and then it's tied to their lifetime. But any other type of beneficiary, non-spouse beneficiary, you have to deplete that IRA by the end of that 10th year. And the IRS knew what they were doing there. You know, on average, most people live into their, mid 80s, and they pass money on to their children who are in their 50s and 60s at their peak earning years. They've been in their careers for several decades, making the most money they've ever made, and now they have to add more deduction or more withdrawals on top of it that are all taxable at typically a higher tax rate. So we have a lot of clients looking at how they can minimize that tax impact, not only for them while they're living, but also when they pass these hard-earned dollars on to their children or grandchildren. Top right here, QCDs to reduce AGI and IRMA, a lot of acronyms there, so I'll walk you through that. QCDs stands for Qualified Charitable Distributions. If you're 70 and a half or older, you can donate to a charity directly from your IRA. And you're not taking a distribution that's taxable and then you're getting the itemized deduction. This is before that would happen. It's going directly from your IRA to the charity. You'd fill out the paperwork with your custodian, whoever holds your IRA. And the idea here is that it's reducing taxable income right off of your 1040. It's not a deduction. So we have many clients that have excess RMDs, money they don't need to live on. And let's just say someone has a $20,000 RMD, they choose to give $10,000 to a charity of theirs, church, charity, whatever it might be. And the IRS says, okay, you're giving $10,000 to that charity. We're going to count that as part of your RMD, and it's not going to show up on your tax return at all. Now you have to take the other $10,000 out. That will show up as taxable income. And then you still take your standard deduction, and if you qualify, the senior deduction. So it's a roundabout way to get an itemized deduction for a charitable gift when you're not itemizing. So that's been really valuable. Again, you have to be over 70 and a half to do that. It also helps with IRMA, which is essentially an additional tax on your Medicare. So based on your income, there are certain thresholds at certain levels, you get to pay more for your Medicare. You don't get a better plan. You don't get, a bigger network of doctors. You just get to pay more. It's essentially a tax. And so if you're reducing the income through these QCDs, it's going to keep your IRMA limits lower. Anything you'd add to that, John or Tim?
Yeah, I think you covered all that well. I think broadly speaking, um, these planning opportunities are very similar to what we would have been telling you 1 or 2 or 3 years ago. Um, I would say it's just maybe on steroids, so to speak, right? There's more at stake now if you have less income, especially with the new senior deduction. And so I want to be clear about a couple things, and it's kind of odd maybe to say as a tax guy. Um, you also don't want to let the tax dog or the tax tail wag the dog, right? And so what I mean by that is there's going to be a lot of pressure, uh, mentally on yourself as you're thinking about your taxes to reduce income to qualify, therefore, for example, the senior deduction, or to give more away in gifts, or potentially give less away in gifts and maybe more to charity because of the estate limit, et cetera. All in all, this tax bill is pretty generous for people who earn less than $250,000. And for everyone else, it is just a little bit more generous, right? And so you still want to make decisions with the lifetime kind of total tax in mind, right? Like deferring distributions from one thing or another to get a $6,000 deduction this year, that may make sense. But if you're kicking that tax can down the road, right, we just want to be thoughtful about it. And so, uh, all in all, there's a lot of kind of calls to action, so to speak, about what you can do to lower your income. And always keep in mind, our point of view for you guys is, of course, to do that, right, and help lower your tax bill. But the overall goal is always for, over the course of your lifetime, what is the best plan for not your finances? What's your best plan for your tax, right? And so that's what we want to try to keep in mind here as we think about these new provisions.
Yeah, I don't really have anything to add. I think, John, you did a really good job summarizing that these questions and these solutions and these planning opportunities like shouldn't be injected into your plan in a vacuum. It should really, look at the big picture and all the other things in your life and your financial plan that you're trying to consider, change, plan for. So yeah, I think that was really well said.
Yeah, and they're all unique to each of you. And those of you that are clients of ours, we're working on all this for you already, and we'll continue to do that and look at these new benefits that may be available to you. I think a big takeaway here is not everything on here applies to everyone, and that's a key takeaway. We're not giving blanket recommendations. We know you all have different situations, different resources. So that's a good takeaway for each of you. I'm gonna go, there you go. For those of you that are clients or have attended any of our other webinars or classes, you've seen this bucket plan. I'll walk you through the concept here and how it relates to your tax picture. So we believe every single person should have a bucket plan, regardless of age. Now you should have a now bucket, a soon bucket, and a later bucket. Your now bucket is your safe and liquid money. It's the income you need over the next 12 months. If you're working, it's coming in through your paycheck. If you're retired, you should have income sources that are supplying that income right into your now bucket, which is typically your checking, savings, things that are safe and liquid. There's no risk here. You also, above and beyond income, you want to have an emergency fund. So roof leaks, car breaks down, whatever might happen, you want to have some liquid money that's there for you when you need it. And then any other planned expenses. If this is a year you're going to take a big family trip to Europe and you need $25,000, or you're going to buy a new car, or you're going to do a big home renovation, those dollars should be parked in your now bucket as well. You don't want to risk them in the stock market. Have it safe, have it liquid. Once you figure out what you need in the now bucket, we then move to the soon bucket. And this is the money you'll need over the next 2 to 10 years. So some of you on here are retired, some are far away from retirement, some of you are right in that sweet spot of you're going to retire in the next few years. And so we want to make sure that all the income you need from your portfolio over the next 10 years is accounted for in your soon bucket. We factor in taxes and inflation. We want to get a better return than we're getting in the now bucket, but we want to have little or no risk here. We want to make sure that money's there for you when you need it. So once you have the now bucket figured out and the soon bucket, you've essentially bought yourself a 10-year time horizon so that the rest of your money could be invested in the later bucket for more long-term growth. Growth means different things to different people. Some people need a lot of growth, others don't. That's very specific to you. But we tell every client, hey, your later bucket, you're going to lose money at some point. We know the market goes up and down. This is growth-oriented money. But the key here is that we're not going to sell anything at a loss in your later bucket. And you don't have to, because we've already built the now and soon buckets that have little or no risk. So you can confidently invest in the stock and bond markets over the long term to grow those assets. Many people are going to have 20, 30, maybe 40-year retirements, and you need growth. It's not this old adage that Money Magazine used to tell people, take your age and put that percentage in bonds when you retire. Well, if you put 65% of your portfolio in bonds when you retire, most people will come up with a shortfall over time because they're not going to have enough growth in the portfolio. So this works really well in practice. the tax angle here is that we want to have different types of accounts in your soon bucket and later bucket so that we can blend different types of withdrawals to manipulate your tax code or your tax picture as much as possible. It's completely legal, but things are taxed differently in retirement. Social Security is taxed one way, dividends and capital gains are taxed another way, ordinary income and IRA withdrawals, those things are taxed differently, and they all impact each other in different ways. So we want to have flexibility as we're building out your income plan.
And honestly, like where this really all comes together is the elevated retirement plan. This is our proprietary view of like what everybody should be considering when they make any type of financial decision inside their financial plan. And I think John did a really good job earlier explaining how tax law changes aren't just about taxes. Like they really do ripple through every area of your financial life. And a lot of people's first take of the bucket plan that Nick just described is, well, this is an investment tool. And while it is, the tax considerations sometimes outweigh the investment considerations, just as an example. So the elevated retirement plan is designed to cover 6 of the most important areas in anybody's financial life. Their goals and concerns and priorities, income planning, investment management, tax management, healthcare and insurance, and legacy planning. It's so important to make sure that you always take into account the domino effect of making one decision in one area of your plan and how it impacts the others. And taxes are literally not anywhere near an exception to that rule. What we found is that when one lever moves in Washington, like tax brackets or state exemptions, like it really never just affects one of these worlds of planning. It generally impacts all 6. So it's our intention with this tool that it connects those so that your plan can adapt and meet you where you're at instead of leaving you exposed when we encounter big sweeping legislation changes like we're talking about tonight. So I know we've covered a lot so far, and I want to pause and open it up to questions. I know I mentioned earlier, there's no way we could cover all of the legislation impacted here, but I'm sure some of you have some questions, and we may not even be able to answer the question if it's outside of the scope of what we covered tonight. But please feel free if something's front of mind, whether directly from what we covered or something else that's just bouncing around, don't hesitate to shout it out. And again, if you're looking for the Q&A, so somewhere on your screen, maybe towards the bottom or the top, if you hover your mouse over it, you might have to click a button that's called More, but you should be seeing something called Q&A. When you click on that, it might open up a different box where you can type in questions. If you're on a mobile device, you might have to swipe left or right to be able to locate that. But in there is where you can type in any questions that we may not have addressed yet.
I'm going to say one thing here. Sherry asked a very good question, and Nick answered it in the chat there if you didn't see it, Sherry, or anyone else. But Sherry asked, are taxes on online sales state taxes? That we're talking about the state and local tax deduction there. Being top of mind with state and local tax deduction, I want to make one important distinction for you all because this is going to be new for a lot of you. In deducting state and local taxes on your federal tax return, you get to choose between deducting sales taxes or income taxes, not both. Most people don't have any idea how much they actually pay in sales tax overall, right? I mean, it's a pretty hard thing to figure out. So the IRS has a table in a safe harbor calculation on that based on your income in your state, et cetera. But to be clear for Sherry and anyone else is wondering, state and local taxes are the combination of property taxes and then and property taxes, by the way, might include things like car registrations, et cetera, transfer taxes, and then either state income tax or sales tax. So just wanted to be clear about that.
We also got another question from Bill. Can a Trump account be open for children who were born before 2025? It looks like Nick's typing the answer. Hopefully we're on the same page. My understanding is yes, it can be. However, it just won't qualify for that $1,000 bonus for children born between 2025 and 2028. Also, I was curious too if grandparents could open Trump accounts for grandchildren. I don't know if this answer is 100% accurate, but my first take is no. Um, John or Nick, I'm not sure if you had a different impression.
I think, and I say I think, I spent some time reading this afternoon, and the three of us had together on a call on this, and we can get in the weeds on Trump accounts for sure. But it's like an IRA, right? So each child can have any number of Trump accounts, but you can only contribute in sum to any number of Trump accounts, $5,000 per child, right? So it's similar. Think about it like 529s, but with tighter limits, and then from there it's like an IRA. And if that didn't make any sense, then try to ask me a different way. But
Right.
again, that's a really new thing.
Yeah, my understanding is only the legal guardian can open the account, but then it's kind of opened, to whoever wants or could contribute within that $5,000 limit. We did just get another question from Karen. Do payments from annuities owned by an IRA count towards an RMD? Yes, they do. Sometimes the calculation is a little bit different. There's a fancy term, Nick, for some reason it's not coming to me right now. The actuarial present value. There it is. Write that down if you're sick of counting sheep to go to sleep. Just look up what actuarial present value means, and that's how you calculate an RMD on an annuity. But yes, distributions or income from those will help satisfy RMDs.
Yeah. One other note on the Trump accounts, I don't know if you mentioned it, John, that they can't be opened until I believe it's July next summer, 2026. Is the
Interesting.
first time you can open them, is what I read. I'm not sure if that's been set in stone yet, but that's what I was coming across.
Hmm.
Do you see
I
something
wasn't
different?
sure. No, I was not sure exactly when you could. I'm glad you read that. I'll have to check on that. But the other basics like treated like an IRA and opened at a qualified custodian, et cetera, that would make sense. It's going to take quite a bit of time for them to nail down the reporting rules for that stuff. So I would think that it's probably something you could take to the bank.
Yeah.
Yeah.
And don't be shy if it's not a question you have, but maybe a concern or a fear, something that stands out about this bill, maybe information you've heard from a news source or in the media that we might be able to help clarify for you. There's no wrong question, there's no wrong answer, nothing too big or small. This is really about your situation. So anything we can do to bring you comfort, just to help you better understand.
Another question in
William,
there.
that's a really good question.
Yeah.
I think I know the answer to this. I think you guys do too. There is no tax deduction for funding a Trump account for anybody. And this is one of the things I thought would be tripping people up as they read it. So, William, thanks for bringing this up. The Trump account is not tax deductible to whoever funds it, but the flip side, right? What's the benefit of even having this thing? Um, the Trump account grows tax deferred until the point that the child withdraws the money. So it's like a retirement account to seed someone's savings and allow the first 18 years of a person's life hypothetically to grow without being taxed along the way. So I hope that answers it for you, William.
Yeah, I don't have
Yeah.
anything to add to that.
Yeah. We have a question from Brian. How about crypto in investment accounts? So currently you can buy crypto in investment accounts. There's a couple ETFs. There's a couple different ways, I should say. So there's some spot ETFs. There's one on Bitcoin and there's one on Ethereum that are regulated by the SEC. It tracks the actual price of the crypto, and you can own those in your investment accounts, IRAs, Roth IRAs, regular brokerage accounts. There's a few of them. Grayscale was the first one to come out years ago that tracked Bitcoin and Ethereum. So those are still available too. They may bring more, as the SEC sees fit, different types of crypto. but right now it's pretty limited. But you can get direct exposure by buying these spot ETFs, which is a safer way to go than buying them on your own. And many of you probably have heard of people's, Bitcoin getting stolen because they hacked into their account and they had no recourse for it. So owning an ETF is, kind of limits that risk quite a bit. There was one thing, I think it was in the Genius Act, um, that is allowing crypto ETFs in 401k plans. So you probably won't see any of those, probably haven't seen any of those yet, but maybe in the next year or two, you'll start to see those being populated as an option in your 401k plan offered by your employer.
Yeah. And Nick, I'm going to say one more thing about crypto for Brian, because there's some new tax rules for crypto that I think are important to know. By the way, guys, I love talking about crypto. I've never actually bought it, and I feel like I maybe should how much I talk about it. This is not an endorsement one way or the other. I guess, we got to be careful about that. But no, the truth of the matter is it's a very new and interesting, exciting thing. But we got a thing here, Brian, that it would be important for you to know and anyone else is wondering. Outside of the OB3, there's been some updated regulations on how crypto is reported. And there's some new regulations around banking and finance that want to make it a more fungible asset in the way of cash that can be traded on exchanges. They're trying to go that direction. That's more down the road, it appears. But any crypto brokerage in the United States that has accounts in the United States must now report your sales and basis and whatever else they know about your activity exactly the same as you would any other stocks or bonds or any other financial asset at a broker. So if you're into crypto, I saw Brian's question and I really wanted to make sure everyone heard this. You may most likely be getting new tax forms from Coinbase, Kraken, etc., in a format that's a little slightly different than you had before. And I don't think anyone here is trying to break the law, but the gist of it is the government is saying, hey, we'll make this more easy for you guys, but now you can't hide it anymore. Yeah. Right. And that's kind of what's going on with crypto.
We'll take this last question from Kathy and then and Pat, and then we'll close out. Kathy said, so is that different than a 529 plan growing tax deferred? I think you're referring to the Trump accounts. If that's the case, the key difference here is that you get tax incentives if you use 529 plans on qualified expenses. You're able to avoid or alleviate almost 100% of tax consequences on growing that money. If you don't use it on qualified expenses, you will pay tax plus a little bit of a penalty out of a 529 account. But a Trump account, once it kind of evolves into what basically looks like an IRA, it's going to work like an IRA. So I imagine, and this is an area that I haven't explored, let me know if I'm wrong, John, but I imagine the exceptions to avoid, penalties or tax in some cases on a Trump account might mirror what some of the exceptions are, like hardship withdrawals, first home purchase, things like that on IRAs.
Frankly, there's just not a lot there. So if you guys want to read some cool stuff about a law and see how the government works, Congress writes a law, the president passes it, and a lot of the law says this is how it works for taxes, this is how things are calculated. United States Treasury, we're delegating the rest of figuring out how this works to you. And so and Trump accounts are one of these instances. For example, the auto loans I was talking about before, the government has directed the IRS to create procedures, forms, reporting requirements to implement this law. And things like exceptions, those are added after like 529 exceptions, for example. Some of these are laws and some of these are regulations that are added and accepted by Treasury after the fact. So long story short, there's just going to be a lot more to see about these Trump accounts, and what kind of exceptions may be. But my understanding now, to be more direct, is that anything for the benefit of the child, like a necessary medical, housing, school, like et cetera. Those things would be accepted from any tax on gain and or penalties and before age 18, right? That's the gist of it. How it's written is a little bit more different, and the Treasury has been tasked with writing those regulations.
Yeah, not to mention our tax code has an entire court dedicated to it where they argue this and create precedent in tax law as like exceptions come up. So interesting. All right. Last question from Pat. Trump account at age 18. Whose decision is it to convert to an IRA? And if not converted, does it become taxable at taxable income at 18? John, I'm going to you. I'm looking at you.
I spent so much time on this today, guys. We could talk about Trump accounts all day. Anyone who knows me knows I'm not necessarily short-winded, if that's the right word when it comes to this stuff. So it converts automatically to the framework of an inherited IRA at age 18. So there, Pat, there's no choice involved, is the way it's written. But your second question is, does it become taxable income? These are kind of one and the same. So, I guess two sides of the same coin. At 18, a child can withdraw the entire amount, and what would be taxable to them at that point is the difference between what was contributed over time and what was gained. And so the child just at that point has choices about what to do with the money. However, it defaults to become an inherited IRA at age 18.
Yeah. All right, we're a few minutes over, so let's wrap this up so we can get you all back to your regularly scheduled routine for the night. I just want to say thank you again for joining us tonight. It means a lot that you allow us to help you understand these things. You trust us. Honestly, giving good information and making an impact in our community this way is something that we love to do. So, while the tax laws change, we don't want you to ever feel like you have to figure it out alone, and that's why we're here. I'm not sure if we'll be able to put it into the Q&A or if it'll make more sense to send out in an email to those of you who attended, but we'd love for you to take advantage of scheduling your free tax strategy session with us. We're here to help. We're here to unpack any of the questions that we weren't able to answer tonight. So if we can get it into the Q&A, please keep an eye out for it there. Otherwise, I think best option is just to send it in an email. So keep an eye out for that.
Tim, Tim, sorry to interrupt. So I just put it's kind of a new version of Zoom for us. So I responded to Brian's question. I don't know if all of you can see that. It's a link to a jot form. And if you can see that and you can click on it, you can sign up for this 30-minute strategy session. If not, you will all get an email from our team tomorrow with a link to this to sign up if you'd like.
Yeah. I can't see it on my end. I'm not sure if that's what that means for the attendees.
Go to the answered section, Tim. Do you see it? And scroll all the way to the bottom.
Yes, now I see it. Beautiful. Like Nick said, we'll include it in the email tomorrow. At that strategy session, we'll talk about your unique situation. So I just want to leave you guys with a thought that, good planning isn't about reacting to headlines. It's about being proactive, just by building a resilient plan that can adapt with you no matter what comes next. We hope that's one of your takeaways from today. Again, we really appreciate you being here. It's our privilege to spend this time with you. And we look forward to those of you who have already signed up for some of our future events, webinars, and educational things. Keep an eye out on your inboxes for more to come. And I hope each and every one of you has a wonderful night. Thank you, Nick and John. Thank you to our team who helped set this up tonight and kept things running smoothly. We appreciate all of you. Thanks, everybody. Have a good night.
Thank you, guys.